Hello and welcome to Stockwatch Live. Now, with the property market on its knees, online estate agency Purplebricks already had its work cut out. And that was before it had not one, but two high-profile investors offloading a large part of their shareholdings. So full-year results on Wednesday will be very interesting indeed. In May, storm clouds started brewing over the company, which still insists it's a world-leading hybrid real estate agency. Chairman Paul Pinder issued the sincerest of apologies to investors, saying the group had expanded too fast and without due care into loss-making markets in North America and Australia, which he said had led to execution errors and suboptimal decisions in allocating capital. Out went its chief executive, Michael Bruce, and a radical scaling back of its international operations immediately ensued. The shares, which have already seen a torrid 18 months, fell yet again. At the current 98 pence, they're a fraction of the 500 pence plus they hit at their peak in 2017. Its shares, in fact, are pretty much back to where they were when they floated on the alternative investment market in 2014 at £1. When it came onto the scene, the Purplebricks model of replacing big commissions for selling properties with small charges for listing them appeared to be the sort of disruptor the sector needed. And it won some high-profile support, one found being Neil Woodford, at the time the UK's most prominent fund manager. However, most of the disruption has happened within Purplebricks itself. It recently became clear that building the business too rapidly has come at a cost, so much so that the UK is the least of its worries right now. And with the revenue forecast for the current financial year trimmed down to the £130 to £140 million range, things are not about to get better anytime soon. Previous guidance had suggested earnings would be in the range of £165 to £175 million. Such was Mr. Bruce's confidence back in 2016 when the online estate agent was about to enter the Australian property market that he said it would be like pushing against an open door. Well, that door closed shut last month when Mr. Bruce left the company and Purplebricks shut down the Australian business, citing tough trading conditions in the Australian market and confessing to execution errors. The US business, which will be trimmed down as well, now has an interim CEO in place. To compound its woes, Purplebricks has felt the direct impact of Woodford's own problems, which have seen him selling shares as he scrambles to raise cash after the suspension of his own flagship £3.7 billion fund. Mr. Bruce, who founded the company with his brother Kenny in 2014, retains an 11% stake in Purplebricks. Broker JP Morgan Cazenove is so far sticking to its overweight investment rating on Purplebricks and has raised its price target from 167 to 186 pence. At the very start of May, UBS said the shares were a clear sell as it drastically cut its price target from 285 to 100 pence. If tricky corporate situations make you feel uneasy, look away now, because when Superdry posts full-year results on Thursday, it's not likely to make for comfortable reading either. Here too, underlying commercial problems have led to founder members being hauled over the coals and called on to explain their decisions. At the last count, founder Julian Dunkerton was back in the CEO role in an interim capacity, but all he could offer was a warning that full-year underlying profits would be below analyst forecasts amid continuing weak trading. Group revenue was flat year-on-year and declined 3.5% in the fourth quarter. Wholesale and e-commerce performance are being hardest hit as a result, the company said, of increased levels of returns, lower than anticipated in-season orders, and decisions not to ship to customers that had reached their credit limits. Online performance, meanwhile, has been adversely impacted by a reduction in year-on-year discounting, including the removal of planned promotional activity at the end of the fourth quarter. You might remember earlier this year, Julian Dunkerton fought a bitter battle that he won, prompting the immediate resignation of the incumbent leadership team. It all started when the clothing retailer issued two profits warnings in quick succession last year, after an unusually hot summer and mild winter had an adverse impact on sales of its trademark hoodies and coats. Dunkerton and his co-founder James Holder voiced concerns about the leadership team's decisions and suggested they should return to Superdry's design-led routes if they hope to have any chance of boosting sales and improving profit margins. The board, firmly wedded to the new global digital brand strategy, which focused on fewer products, more sales online and overseas, and diversification of the Rad Dad brand into ski wear and children's wear, disagreed. A very public spat ensued and was only resolved when Dunkerton called an emergency shareholder meeting at which he was narrowly voted back onto the board. Any remaining non-exec directors will leave on the 1st of July. With the Superdry brand back in founding hands, Dunkerton didn't let the negative position the company was still in, though, dent his positivity about the future shape of the fashion retailer. He told shareholders he'd already identified immediate opportunities to improve the efficiency and performance of the business and taken the necessary steps to achieve them. These include filling flagship stores with more stock, reducing unnecessary promotional activity, resulting in boosted margins, and creating 500 new products to be introduced in the first 6 months. Dunkerton said his first priority had been to stabilise the situation and address Superdry's recent weak performance, and that while the changes would take time to come through in the numbers, they would get there. RBC Capital Markets has kept its faith in Superdry as a sector performer, but cut its price target by 20p to 500p. Liberum Capital has raised its view from hold to buy, along with its price target from 500 to 600p. And that's it for this week. To follow the companies as they report in the week ahead, go to the Markets and Insights section at fidelity.co.uk. See you next time.
Great, well done.
Sorry, that was a mash, wasn't it? Right, mash up.
We'll just do the social media bit when you're
Okay. Two well-known companies are in the spotlight this week, both reporting full-year results. Online estate agency Purplebricks and fashion retail... Two well-known companies are in the spotlight this week, both reporting full-year results. Online estate agency Purplebricks and fashion retailer Superdry have had more than their fair share of corporate contretemps, not to mention founder members coming and going. We'll find out if the dust has settled in either camp when results come out next week. To find out more, join me for this week's Stockwatch Live.
Great, well done.
Is that all right? Okay.
Did we ever discover why the line was on there?
No, but they've gone and stuck it in the Daily Mail.